Welcome to vTalkInsight, Risk Sentiment Daily for March 12, 2026. Energy markets remain the epicenter of global risk, with the Middle East shock feeding stagflation concerns and putting pressure on both equities and bonds. In the next few minutes, we will unpack how this persistent supply disruption, shifting rate expectations, and a handful of resilient growth themes are shaping risk appetite across global portfolios. Across assets, today's picture is best described as stagflationary risk-off. Oil remains elevated and volatile, inflation risks are being revised higher, and yet growth expectations are edging down, creating a difficult backdrop for both equities and fixed income. Recent price action in U.S. stocks has been modestly negative, while volatility sits in the mid-20s, signaling unease rather than outright panic. The tone is defensive, with investors more focused on capital preservation than chasing upside. The dominant force behind this mood is the Middle East energy shock. Effective closure of the Strait of Hormuz, attacks on vessels, and mine and drone threats have taken a meaningful chunk of global supply offline and disrupted shipping for oil, LNG, fertilizers, and other commodities. Policy responses so far, including talk of record-sized strategic reserve releases, are widely seen as lagging the scale of the disruption. That gap is keeping a sizable risk premium embedded in energy and spilling over into broader asset pricing. Against that backdrop, equity markets are still showing pockets of resilience, especially in quality and technology, but the cushion is getting thinner. Risk premiums across equities and bonds remain historically low despite the surge in macro uncertainty, and headline indices mask deep drawdowns beneath the surface. Compared with the more two-way tone seen earlier this week, today's configuration looks more clearly skewed toward defense, with investors increasingly questioning whether equities are adequately discounting the energy and inflation shock. The first major driver is the persistent Middle East energy supply shock. Maritime security threats and direct attacks in the Strait of Hormuz have effectively shut down a key global shipping artery, disrupting flows of crude, refined products, LNG, and fertilizers. Estimates suggest current disruptions are removing more than 10 million barrels per day from the market even after assuming very aggressive use of strategic reserves. Restarting over 6 million barrels per day of offline production is expected to take weeks, not days, underscoring the risk that this is not a brief interruption. On paper, the International Energy Agency's proposal to release 300 to 400 million barrels from reserves sounds enormous. In practice, logistics and flow constraints mean only a fraction can hit refineries quickly, and even a record release would cover less than 10 days of lost supply at current disruption rates. Past episodes show that similar interventions have provided only short-lived relief, with prices resuming their climb as traders interpreted emergency drawdowns as signs of official concern rather than durable solutions. Today, inventories are being drawn down rapidly, and hoarding behavior by both countries and households is amplifying demand pressures. This sustained energy shock is driving significant volatility, with Brent having traded in extremely wide ranges and spot volumes spiking before many professional traders stepped back amid headline risk. Commodity strategists increasingly frame current conditions as crisis level, while equity markets still appear to be pricing in a relatively transitory event. That divergence raises the risk of a more abrupt adjustment, particularly for energy importers in Europe and parts of Asia, where equity markets are seen as vulnerable to further downside if supply interruptions drag on. For portfolios, the message is that energy remains a central macro risk factor, with the balance of probabilities skewed toward a longer and bumpier normalization path. The second key driver is rising stagflation risk and a higher-for-longer rates narrative. The current oil shock is expected to shave roughly 0.5 percentage point off global growth while adding about 1 percentage point to headline inflation. Retail gasoline prices are already moving sharply higher, with estimates that a 20% increase could lift headline inflation by around 1 percentage point and deliver a real income shock to households. That pressure is particularly acute for middle-income consumers, who are already seeing savings rates fall and credit stress indicators tick up. In response, markets are steadily pricing out the prospect of imminent rate cuts. European central banks are now discussed in the context of potential renewed hikes. The Bank of England is expected to delay cuts until late in the year, and the Federal Reserve is widely seen holding policy steady through at least the first half. Recent reacceleration in key inflation gauges, including core personal consumption expenditures, further limits room for easing. Policymakers face the classic stagflation dilemma. They have limited tools to offset supply-driven price spikes, but remain determined to keep medium-term inflation expectations anchored. For risk assets, this combination of softer growth and stickier inflation is particularly uncomfortable. Equities are pressured by potential earnings downgrades and higher discount rates, while bond markets face the prospect of yields staying elevated even as cyclical momentum cools. Signals of consumer strain, from rising credit card delinquencies to broader financial stress moving up the income spectrum, add to downside growth risks. Together, these forces support a regime where volatility remains elevated and where the hurdle rate for adding cyclical risk stays high until there is clearer evidence that the energy shock is fading. The third bearish driver is stretched valuations and underpriced downside risks. Despite persistent uncertainty around energy, geopolitics, and inflation, risk premiums across both equities and bonds sit near historically low levels. Headline equity indices remain close to two-decade valuation highs, even as under the surface, many individual stocks have already suffered sizable drawdowns. That disconnect suggests that benchmarks may be giving a cleaner signal than the lived experience of active managers. Recent market behavior reinforces that sense of fragility. Average maximum drawdowns for S&P constituents are in the mid-teens and near 30% for some Nasdaq names, even though aggregate indices have seen only modest pullbacks. At the same time, short-term speculative trading now accounts for a substantial share of daily volume, amplifying intraday swings and rotations. Several large hedge funds have reported material losses, driven by sharp factor reversals and the lack of obvious safe havens in either equities or duration. Overlaying those dynamics is a growing concern that equity markets have not fully priced the ongoing energy supply shock. Commodity specialists warn of crisis-level risks, while equity pricing still implies an 80% probability that the oil disruption proves short-lived, versus an estimated 50% probability from macro analysts. That gap raises the risk of a more abrupt correction or even panic if the Strait of Hormuz remains closed for an extended period. For allocators, it points to the importance of recognizing how thin the valuation cushion has become at a time when macro downside tails are thickening. Balancing these headwinds, AI and tech earnings resilience remains a notable bullish driver. Oracle's latest results, with strong AI cloud demand and an upgraded revenue outlook, triggered a double-digit share price jump and underscored the strength of spending on digital infrastructure. This follows a broader pattern where semiconductor and AI-related names continue to deliver solid earnings, even as macro uncertainty rises. That earnings visibility provides a degree of support for parts of the equity complex, particularly where balance sheets are strong and cash flows are less sensitive to the energy shock. There is also a structural angle. AI-driven productivity gains are expected to put downward pressure on real wage growth over time, introducing a potential disinflationary impulse that could offset some of the inflationary pressure from commodity shocks and resource stockpiling. China's strategic emphasis on technology, AI, batteries, and green energy further reinforces this theme, suggesting that capital and policy support for these sectors may remain robust. While this does not immunize tech from volatility, it does create a pocket where long-term growth narratives remain intact despite the broader risk-off tone. Another supportive element is that central banks are cautious, not over-tightening in response to the oil shock. The Federal Reserve is expected to keep rates unchanged at the upcoming meeting and has signaled it is more focused on core inflation than on temporary spikes in food and energy. Policymakers have indicated they are unlikely to react aggressively to oil price jumps unless clear second-round effects emerge, such as wage price spirals or profit-driven inflation. So far, labor markets are notably less tight than in 2022, and wage pressures are more subdued. Outside the U.S., many central banks are also prioritizing the anchoring of medium-term inflation expectations over short-term headline moves. while some, like the European Central Bank or Bank of England, may lean slightly more hawkish given their inflation challenges, the overarching stance is one of patience rather than panic. That approach, combined with evidence that the pass-through from higher crude to consumer prices typically takes several months, supports the view that the current shock, while painful, does not automatically imply a deep recession. For markets, it means the policy backdrop is restrictive but not yet in deliberate demand destruction mode. The final bullish driver is the relative resilience of energy exporters and China. The U.S., now a major oil producer, is seen as less vulnerable to energy shocks than in past decades, and currencies of exporters such as Norway are expected to hold up better than those of large importers. Conversely, European and Korean assets look more exposed to sustained high crude prices, with equity re-rating prospects closely tied to how quickly regional supply risks are resolved. China stands out as relatively insulated in the current episode thanks to prior crude stockpiling and ongoing domestic deflationary pressures, which blunt some of the imported inflation. Its focus on technology and green energy also positions it to benefit from parts of the structural transition underway. More broadly, many emerging markets enter this period with stronger balance sheets and improved policy frameworks, even if recent volatility has forced some unwinding of overweight positions. These pockets of resilience do not negate the global risk-off tone, but they do create important differentiation for cross-asset and regional views. To sum up, risk sentiment today is firmly skewed toward a stagflationary risk-off regime, dominated by a persistent Middle East energy supply shock, rising concerns about higher-for-longer interest rates, and stretched valuations that leave limited room for error. Set against that, resilient AI and tech earnings, cautious central banks, and relative strength in energy-linked economies and China provide selective buffers and help explain why broad equity indices have not yet fully capitulated. Watching how quickly energy flows normalize, how inflation data evolve from here, and whether equity risk premia start to rebuild will be critical for assessing the next phase of market pricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.